I hope everybody is energetic now. How many of you follow cricket here? Very few people. Okay.
Yes,
I
everybody.
think other people are not raising their hands because they'll be saying that we are busy in investing and managing portfolios, so we don't have time only. So, I feel like in India, people are usually talking about batsmen. What are the qualities that makes a good batsman? What is the difference between a regular batsman and a good batsman? Can I get some guesses? What are the qualities that you will look? Consistency, yes. Aggressive. Strike rate, yeah. What was it? Fitness. Well, I got so many nice guesses, and yes, it follows into the answer that I thought would be the answer. So, I think when we talk about a good batsman, we are always looking for somebody who can judge the conditions, who can adapt to different pitches, because we have different kinds of matches. We have tests, we have ODIs, we have T20s. So, a good batsman is a person who can adapt to all of these market situations. And at the same time, quick decision making, the ability to judge the ball before it hits the bat. So similar qualities are reflected by Mr. Sandeep Tandon in the field of investing. He has grown his AUM from 500 crores to 1 lakh crores in just a few years. Under his leadership, Quant Mutual Fund has seen significant growth. So here, I would like to focus on one point where when we talk about batsmen's analogy, it's not just what they're doing today, because we have seen so many batsmen come today, they have done good, but then they were not consistent. So it's something to do with what makes them relevant for tomorrow as well. So here, I would like to invite Mr. Sandeep Tandon on stage to talk about being relevant. Can we have a big round of applause for him, please?
To welcome Mr. Sandeep on stage, let me invite Mr. Padmanabhan to honor him with a bouquet. Please. Sir.
Before I come to my main presentation, I just want to recap what we said in January, what we said in February, how we look at 1st April, and where we stand today, because I'm sure everybody has anxiety to understand the markets. Now, if you go back in January, I think I was in Chennai or Madurai, I don't remember it. Okay. So what exactly we talked about in the beginning of 2026? We talked about fragile 2026. We talked about geopolitical risk in first quarter. We talked about crude spike in first quarter, and we talked about collapse in gold and silver prices. Okay, this was what we have talked about, how the P multiple of of the markets have expanded globally, and how the bubble of AI, I will still not use the word bubble, some hype which is getting created has a potential to correct. This is what exactly what we have talked about. Now, being in South, gold is something very important, and I distinctly remember it was 5,000 plus when we met, okay, and everybody was big hype about gold and silver. I at the time also said this is not the time to participate in the ETFs, which most of people were jumping around. It's a time to look at multi-asset, at least leave the conviction with money managers to time the market on the gold and silver, okay. Now, we talked about how this particular asset class will remind you about crypto. So we said in 2026, you remember gold and silver price movement like a cryptocurrency. And this is, we have seen sharp spike, sharp rise, and big fall also. And if you just recollect what we talked about certain levels, we are coming closer to our lower levels. So we talked about how potential of silver 60, and I will not be surprised to see 40. We are closer to that mark. We talked about 4,400 gold, and maybe on the lower side 3,800. How beautifully that range has worked, okay. And obviously, when you see those levels, I will not be surprised if month end you see some of these levels, okay, or by end of this year you will see these levels. So it's very important to understand how timing plays a role. Okay, that's the reason I always say postmortem analysis is very easy, and we sometimes take a big call based on our predictive analytics, and that plays a role because ultimately it's all about analytics, and we always say 28% times we are always wrong, but 72% time we get it right. And that is very important to understand from a consistency point. It's not about every month, every quarter, every year you have to be. If you get these big ranges right, and if you get these inflection points right, then big difference come over a period of time. And this is something which we want to talk about. So we sold gold a big time, silver we cut down, okay. We look for opportunity if data points are constructive to rebuilding our exposure, and something situation is coming closer to those numbers. Now talked about crude. Without knowing this battle will come up or this war we have seen, in the February we talked about crude has potential to spike. Our expectation was not even 120, it was around 90 levels, but spike very clean. But what is very important, around 120 when the whole world was talking about 150, 180, 200 levels, we said that by end of December it will be $70, okay? And we are approaching that mark. Now what is important to understand, you don't have to look at the price data. Price data does not give you much. When you try to analyze, based on few data points, we talked about how the employed volumes of crude spike. It went to 180, 200 level, 200%, and that started collapsing, which means market implied analytics, which we look at, and we create a lot of our entire thesis on market implied. What is the smart money is looking at? The global participant was not looking at higher crude prices in the medium and long term. That was data was indicating. And that was the conviction we set $70. We are very close to that mark now, okay? When people have virtually given up. So if you really look at the peak of the cycle, when it's a time to really take advantage, people are slightly scared, and when it's a time to be cautious, people are more optimistic and euphoric conditions are there. So again, good news is for India. The concern which we had related to crude is settling down. We have paid a huge price. Government of India has absorbed nearly 6 lakhs crore. That's the hit which they have taken, which they have actually not passed to the investor in a big way. Obviously, it has its own impact to the fiscal of this country. So let's see how it shapes up. So it's very important how we play out this game. Now, this is the risk which we talked about, how the currency part, I will skip it, okay. Now, what is important to understand, 1st April, in our fact sheets on various forums, even on media channels, I said, worst is behind us, okay. We talked about rally in Indian equities. We talked about small cap, mid caps, micro caps will do well. We thought micro will outperform small, and small will outperform mid, and mid will outperform large. That's the way we looked into it. And we talked about, and closer to March, I don't know which seminar I was there in, maybe in Cochin, I talked about April onwards is a time to look for opportunity. We were very lucky to get it right even the month also. So what is important when you see these extreme inflection points? That's the time you have to stick your neck out. With most of the participants, what happened? People get so fearful at that's the time when people are about to vomit, okay? That's the time market bottoms out. What is important for us? One is the behavior observation. Yes, you can say that this is what happening. We are all very nervous. So one data point is that when I am also becoming extremely nervous, I also look back and say, this could be a bottom. That's a one data point. Second thing, if you can quantify. The quantification is the most important aspect in our investing area, okay? Where in this country, I have seen majority of the participants play passive style of money management, okay? Quasi-passive, okay? Though we take active management fees, but we offer quasi-passive products. 70-80% we make the indices in the name of risk management. That's not actually risk management, okay? And then we try to outperform with only 20% of the performance. And that thesis has been failed miserably in last 1 or 2 years. If you really look at, ask me this question globally, what has happened? The skewness, which we have seen with Magnificent 7 stocks, 2 stocks in Taiwan or few stocks in Korea, the people who are running the skewed portfolio have outperformed decisively. And people who are mimicking the indices, they have underperformed and failed miserably. That's a trend which we have seen. And it's a very important observation because I always talk about how from 2008 onwards, when the liquidity crisis hit us, this is some first time most of the market participants saw the liquidity crisis. They were not aware of this part. This is something new. And it's the reason we built liquidity analytics also as a thesis for us. 1 minute. Yeah, it's better. So the point which I'm trying to highlight is that everybody tried to copy the indices because people were not sure where market is heading. So everybody parked their money in mimicking the indices. This is a trend which we saw globally. India, we captured later on. And market was even smarter. The retail participant was much more smarter. When you were started offering in the name of active management passive product or quasi-passive product, people move toward passive product big time. Okay? And that's the way the genesis of passive product from 2012 has increased significantly in terms of growth. Now, given the high geopolitical environment which we are living in, we think last 2 years or 1 year in particularly has a clear signs that money is again shifting towards active money management. And few countries, few stock is a very classic example how we have seen a really re-emergence of active money management, and not only India, globally. And this is something we always talk about, how with the help of analytics, instead of doing a postmortem analysis, you have to do a predictive analytics, and that plays a big difference in terms of thought process. Now let's talk about what we have said in the April onward. This is a thesis we still continue, this mid rally. You leave the indices levels, just focus on the stock. Next few months, next few quarters is all about stocks. Maybe large cap indices or the broader indices will not give you much inferences. Now I'll just want to talk about the real presentation. Success of our VLRT framework. Okay, we took over escorts in 2018, and 2020 we implemented our VLRT framework. And I just want to spend some few minutes and try to explain what exactly we achieved in last 6 years. Okay, the first outcome, obviously we are 1 lakh crore and 1 crore investor. That's the first outcome. It showcases what we build. Though we talk about 30 years of AMC business, but yes, the previous company has established in 1996, so we took advantage. But we as a house are running Quantum Mine as a thesis or predictive analysis thesis for last 30 years, and we are celebrating that also. Now let's look at the outcome. These all schemes where we have completed 5 years, okay? And these are all historical dates we have taken. Some schemes are there from 96 also, and some schemes are as late as 2008 also, okay? Now what is very interesting to see, what is our 5 years return journey, since we all talk about equity market is from long-term 5-10 years perspective. Let's see how this last 6 years, what we have created, okay? And it's a very interesting data that all our schemes which has 5-year history actually are quartile 1 on a 5-year basis. Except mid-cap, most of the schemes are actually number 1. Number 1 is not very important for us. What is very important is the quartile. And what is important is the gaps which we have created versus the benchmark, what we did. And it is equally important to understand how the framework worked for us. It's not a coincidence that only 1 or 2 schemes are there. Across all the categories which we have 5 years of history, we are leading. We are talking small cap, mid cap, large and mid, infra or hybrid product, or our focus cap, or even flexi cap. So it's a demonstration. If the framework is right, thesis is right, we are talking about dynamic style of money management, how analytics plays a role. We are not against the philosophical approach. We'll talk about that. If you are living in a very complex dynamic world, your money management style, I always say, cannot be very static. If you can't change, you can't have agility with you, then it's very difficult to survive in the context which we are looking at. So this is the very important success what we have tried to showcase. Now we as a house always talk about from macro to micro. Our entire focus is on macro. Somebody asks what I have to do with the Bitcoin, what I have to look at the junk bond index, okay? People do track it, but here we are a very stock picker. We are looking at more from earning potential. Most of the analysts in this country or globally, I have seen only talk about earnings. Earnings are important, but P multiples are also very important. It's very important to understand when you get into the P multiple expansion or contraction phase. We have seen phases in the market where earnings have expanded, but prices have become 50% corrected or 40% corrected because P has contracted. So it's very important to talk about the perception analytics, how perception is changing, whether market has discounted that thing in advance or we're looking at much later rate. So the entire thesis is all about looking at the global risk appetite, looking at the global liquidity apart from the fundamental data or macro data we're looking. For us, these are all global macro, which we track very closely. And it's very important, like how in 2008, the failure happened. We learned the importance of liquidity analytics. And from there, we build the thesis of money flow analytics, how money shift from one asset class to other, how money shift from one stock to other. It's very important thesis, what type of participant virtually give up at the bottom of the cycle, okay, and how people react at the peak of the cycle. That's the way we try to capture how money flow analytics work. And this is the way we try to create our VLRT framework. And so very important data points, when we talk about VLRT framework, it's a risk mitigation framework. A lot of people who see timing, it's a mindset issue, okay? So timing analytic is a function of valuation analytic, risk appetite, and valuation analytics. These three theses has really worked for us, and we give 1/3 weightage to each instead of giving 90% weightage, which most of the houses give towards the valuation analytics. So it plays a very important role in terms of how these 4 dimensions plays a role in our real life. Now, important aspect is that we have seen houses are dependent of few money managers, okay? And that's a risk people run as a house. And we have seen this trend, one particular money manager leaves. The rotation happens, the next guy comes and dump everything and rebuild that position, okay? Irrespective of market condition, irrespective of that. The most important point we are trying to create, how we are creating an institutional framework, a process-driven framework, which is beyond individual, it is beyond money managers. It's not about a particular money manager who becomes a high profile. We are creating institution. We are building processes around that. We have invested $24 million in last many years in building our analytics. Every year we spend $1 million to support that data points. So the entire thesis revolves around our analytical team. And that's the reason in Quant, we don't have specific scheme, specific money manager. Team works. You see the same money manager across SI product, same money manager across mutual fund schemes, same team manages. So we run as a house, as a team, because it's a house view. Because house has a common data team. That makes a difference. I have seen one manager does not like the stock. He is a seller, and same AMC other manager is buying because he likes it, okay? Now you can't have this sort of thought process if you run a comprehensive analytical team. You can have your own individualistic. That's the reason we say that in my own company, my own view doesn't matter. What matters is data. I always ask me, show me data. Data skewness really help us in taking a call. So when we talk about multidimensional aspect, when you talk about money manager strength, this is a combination we look at, not in isolation. And this has been some amount global practice which we bring. Now let's talk about in terms of philosophical aspect. I have seen and heard, I'm a value investor. I'm a growth investor. I'm a techie, okay? I follow this sort of framework, okay? I have particular style of doing thing. I do something style in particular philosophy. We are not against that. What is very important, the philosophy does not compound. It's the return which compounds, okay? And that's the reason we are always talking about sometimes philosophy act as a limitations. And we have seen n number of times. Let me give you a very small and blunt example. 2013, when Indian market saw a massive rally, the second phase of market will happen. The growth style did very well. Till September 2021, we have seen massive rounds of PMS, AI got flourish. But September 2021, majority of those houses who were very successful in that period underperformed. Because growth cycle peaked out. So if you have a particular style of doing it, you will be very successful in particular phases, okay? And people wait for those phases to come back so they can demonstrate their true potential. That's not the way we operate. We are very clear, we are style agnostic, market cap agnostic, thesis agnostic. It's all about how well you capture these multiple data points. So we run a complex multivariate model, and there's skewness which we thrive. Very important to understand. It's a approach which we look at, okay? I'm not trying to criticize. What I'm trying to give you our perspective, how we are able to generate alpha on a continuous basis over the last 3 years, 5 years, from longer term. We as a house do underperform. We always say in a risk on cycle, we create and generate extra alpha, which help us in a downtrend cycle or consolidation phase. We underperform also. That's also part of our strategy, because in a risk off period, you cannot implement the same style, same way of managing money. Environment changes. So we are student of adaptive asset allocator. We try to understand what type of environment is prevailing from a macro perspective, and then we try to take advantage of the situation. Now, let me run through, since we are talking about success of VLRT framework, we have tried to address all our schemes. We manage nearly 35 schemes right now, which include some of the SIF, predominantly equity house. We don't have very much presence in debt, insignificant presence. So maybe 99% is our AUM is the equity market. Now, if you really look at a large cap, 3 months, 6 months, the ranking, what returns we have generated, forget 3 months, 6 months. What we build in 3 years, again, you will see a top quartile performance. Focus fund, large and mid, value fund, which has not even completed 5 years, one of the best performing fund in that category which we build. It's a perspective. It's not about one fund has done very well or particular theme has done very well. That's the way we talk about how the philosophical approach. Entire as an organization, you talk about hybrid product, you talk about our BAF or DAF, we call it. Multi-asset has been a very unique product. It has outperformed various indices in that category in 1 year, 3 years, 5 years, 10 years. It has beaten small cap index, it has beaten mid cap index, it has beaten large cap index. It has beaten best of the performing fund in that category. That's a very interesting data which we have recently somebody shared with us. Look at the Flexi cap fund. It has been a leader in 1 year, 3 years, 5 years, 10 years, and consistent performance. So when you talk about consistent performance, it's not about 1 quarter, 2 quarter. When equity talk about 3 years, 5 years, 10 years, okay, even you underperform for a certain period, ability to pick up is there because if your portfolio construct is right. And that's what makes a big difference for us. Now, I'll just give you perspective. Quant fund, though we are not just a quant house, we call it quantamental. Look at the performance what we built in last 5 years. It's a top quartile fund in that category with a momentum which got built. Infra has been very old fund. Look at BFSI. It has done remarkably well. When the entire sector has done bad in last 1 year, it has given 20% return in the banking space where the market has actually given negative returns. Now we talk about even the tech fund, okay? We call it our tech thing. In last 3 years, IT stock has been butchered. We have delivered 26% return nearly, more than 25% return. It gives you a perspective how the stock selection plays a role. It's not about if we could have mimicking in the indices, then we could also be minus whatever the percentage, maybe few percentage. The ability to outperform the benchmark which has given negative returns, we have given 25% positive return, and that too in last 3 months. So this is what our healthcare. Look at the commodities fund, which we have not even completed 3 and 5 years. Some of the PSU fund. I'm just running everything. So it's not like we are trying to showcase few schemes which has been successful, running all the product. Look at the text which is leading the category in 3 years, 5 years, 10 years perspective. ESG is a concept which has not picked up. We have 5 years old fund. It has been a leader in even 5 years category. Small cap has been a leader on consistent performance from a longer term perspective. Look at our mid cap, yes, underperformed last year. We have made drastic changes. There's a one fund and mid cap centric fund has not done that well. So you talk about consumption, manufacturing, equity saving. I'm just skipping these things. I'm just giving you a perspective. Now I want to spend few more minutes on the Flexi Cap as a theme we want to talk about. What different we have done, because this is the biggest category in the industry, and how this fund has been a leader. Okay? So we are talking about long-term data instead of talking about 1 year, 2 years. Okay? We are talking about 10 years performance. How 10 years CAGR actually is the number one fund in the industry, whether you look at the direct program or looking at the regular thing. What CAGR return in 10 years? 19.6%. Okay. So out of 20 flexi cap category, which we have in 10 years, not all of them, some of them are very new, it is a leading fund in that category. And when I come to risk-adjusted return, even it is better. But purely on return perspective, this is how flexi cap has delivered. Now we look at the performance. Very interesting data on consistent. 3 months, 6 months, 1 year, 3 years, 2 years, 10 years. Okay, either is number 1 or number 2 in that category. And returns we're talking about, 1 minute, a CAGR return of 19.6, nearly 20%, 5 years. So if you look at as your investment horizon is rising, your CAGR returns are actually increasing. So it's not a one particular phase which has done very well. Yes, 2020-21 was extraordinary years for us. But still, if you look at from a longer term perspective, what exactly we have built is something which we are very proud. Now, if you really look at even from the SIP perspective, okay, how the SIP returns are there. Sometimes SIP returns are very different from your normal schemes return. But even you look at how in last 18 years, XIR are 16.35. If you look at last 10 years, again 19.57. So even your SIP returns are extraordinary, some of the schemes which we have delivered. Now, what is important for us to really look at the success of VLRT? Now, this is our own performance. The management change has definitely happened. So from September 2008 till 2016, it took nearly 8 years to double our money. Okay. From 16 to 21, it just took 4.5 years, and 21 to 23 is just less than 3 years. So it gives you how cycle have been compressed in terms of doubling your money from 8 years to nearly 4.5 years to less than 3 years. Okay, so it's very important that we are able to multiply your returns. Okay, don't look at just 3 months, 6 months, 1 year return. What happened in last 1.5 years? What is important? Even over a period of time, where we are coming from, we are able to generate this alpha on a consistent basis. We are not bothered about from a very short-term perspective. This is what we are trying to look at. Now, why flexi cap? A lot of people comes to with me, small, mid, you are a small cap house. Okay. I always say, give us money to us where money manager has highest flexibility. So within the equity area, flexi cap give us highest flexibility. We can have any combination. Right from 2020, we are running our portfolio very skewed towards mid, and 84% was mid and small by March or July 2024. After that, we took a risk of call. We underperformed also in that period, and we shifted towards large cap. And in last few months, our mid and equity exposure is increasing month on month in the category. And that is what is very unique. Okay, instead of you trying to say that I am a very good small cap guy or mid cap perspective, based on the risk of environment, based on our analytical skill set, we think as a house, as a professional, we will do far superior returns. If you look at nearly 20% CAGR, it's an outstanding performance from a 10 years perspective. Okay, and your small cap has not given that 20% CAGR if you sum with some of the funds which we analyze. So it's a great product. The category obviously is clearly number one. What is very important to understand the flexibility of a money manager. We as a house always thrive on the flexibility. We are not going to bother too much about this is a large cap I have to maintain, this is a sector weightage I have to bother about. We are completely agnostic. Okay, we don't bother. We have guts to make technology stock zero in our portfolio. We have guts to make auto sector zero in our portfolio, which majority of the people cannot do it because it is perceived as a risky strategy. Yes, it is risky, volatility can be higher, but it's about the conviction strategy. If I have a conviction, September 2018 or 21, we said IT sector is peaking. Since then, our weightage is bare minimum. Only in last few days, we have increased a bit exposure because we think technology stocks are now reaching the hated, neglected territory zone. We are not saying that they're going to do extremely well from these levels because a lot of data points are still not supportive. But what is important for us, a flexibility which we want to get in this product. And similarly, this is for equity investor. If you have to really talk about even from the conservative investor, Instead of you putting money in gold, silver, or doing any other fixed income calls, the best strategy is to put money in the multi-asset. As a money manager, I get extraordinary flexibility. Apart from it's a flexi cap, plus I have a flexibility on asset allocation. If we are able to spot gold and silver top when everybody was getting sucked in, we have now opportunity to participate in even on the other side of the SIF product, even multi-asset allocator fund which we long. We can talk about crude, copper, zinc. Now everybody can think volumes are very low. 1 year back, people used to complain the silver volumes are low. As market grows, the liquidity is automatically generated. So it's a very important thesis we ought to talk about. The multi-asset allocator product also, or multi-asset mutual fund schemes, whatever way we want to look at. Again, a flexibility. Now, what is important for us as a house, if I have to summarize our entire discussion, this sort of approach which we have demonstrated, we are the first house to bring a thesis of dynamic style of money management. You don't have to have certain biases. We all have grown with our own preconceived notions. As a behavior house, we look at, ये तो लेना ही नहीं है, ये तो छूना ही नहीं है, ये तो touch ही नहीं कर सकते. I know some of the sectors, some of the corporate houses, people say these are untouchable names. Same houses are buying now. They have become touchable now. Okay. What is very important, we don't bring biases. Biases, the day you bring biases in your analytic, the problem starts. The day you feel you have arrived, the problem starts. And this is what we are talking about, agility, flexibility, and be adaptive. Thanks a lot.
Thank you, Mr. Sandeep. And congratulations on the performance coming back in Quant.
Yeah, thanks.
Let me invite Mr. Selvaraj to honor you.
How are you?
So we'll break for lunch.
Thank you.
Lunch will be cut by 25 minutes as we have exceeded our time. And
Thank you.
item will be there. Time will be cut so you can't enjoy the items. And photo booth, please don't forget, this is the right time to visit the stalls. And those who are fasting can be on the stalls and the photo booth. Thank you.